And
It is a tough market.
Are we late to the game at this point?
I don't think we're late to the game. I think, look, the Fed has basically told us once, told us twice, and now told us 3 times that they're inflation fighters. And so what they're going to do from here on out is going to be to fight inflation. And we should expect those continued high inflation prints. So from a portfolio perspective, this does make it a little bit challenging for investors because it's hard to find conviction in this market. What we've been doing, and we've been doing this over the past couple of months, is upping quality. Because when you look at the different scenarios that could play out from here, you could either say it's going to be robust, it's going to be resilient, or we're going to be in a recession. We're in the middle of the road in terms of resiliency. And so with that, you want the companies that can actually withstand these supply shocks. You want the companies that can withstand the inflationary pressures and actually have durable demand for their goods.
So what does that look like? And to the extent you think, I mean, are you in the camp of where Deutsche Bank is on what this whole year looks like 12 months from now?
We're in the camp where we could actually expect some modest returns and that quality companies will perform. We're also in the camp of just having balanced portfolios, even looking into the fixed income markets. So one of the areas that has absolutely gotten crushed, obviously, in first quarter is fixed income. One of the things that the market is very well pricing in right now is the Fed's path. Have we reached peak rates yet? Maybe not. But what we're looking at, especially within the intermediate space, is some opportunities there. So look at where munis are. Munis are actually becoming very interesting for taxable investors. When you look at that spread and the yield ratio between munis and treasuries, once that starts to hit about 80% and you see what the taxable equivalent yields are, which are in the high 3s, that becomes an interesting way to diversify portfolios.
Because what do you tell the investor who's watching right now, who is, let's say, almost all in on equities? Meaning most people have not been playing the bond market the past couple of years because that's been not the place you've wanted to be.
I would say if you're all in on equities, you need to check some of your concentration. So take a look at what sectors you're exposed to. Take a look and make sure that you don't have any outsized concentration risks within your portfolio. And remember that in inflationary environments, you want that bias towards quality, towards large cap. The other thing that I will say is look at the volatility market. So when we have these opportunities where even earlier this week, the VIX was at 18, 19, we saw it come above 20 on the back of the Fed's release of minutes yesterday. But that 18, 19 creates some really interesting opportunities to create some portfolio hedges. So when we see volatility come down, take advantage to put hedges in place so you can stay confidently invested. When you see volatility spike, you can actually monetize that volatility and sell some options, whether it's to augment yield or actually to build positions at a discount to where they're currently trading. So volatility isn't always bad. You just have to take advantage of those movements.